Hello and welcome back to the Junior Markets YouTube page. Today we're going to be going over the CAPM formula and associated problems for Finance 3000. This is specifically from the UGA course. I pulled these questions from different tests and homeworks from previous semesters as well as this semester. So this is all directly from the chapter book and things that you will be learning in class. And I know Finance 3000 might just be called FINA 3000 at UGA, but all of these concepts can be learned in the introductory finance course across all of the different introductions to the business college in many different colleges. And I know that some students in MIS or marketing or management might have trouble with some of these concepts, at least from what I've seen. And so I wanted to kind of maybe shed some light and maybe give another way of talking through some of these problems for these courses and ways that help me remember what's going on, because I love this stuff. I enjoy learning about it, and so maybe I can give a bit of a different perspective. And so I have about 10 problems here from the CAPM formula. This is from the second half of the semester, starting after the first test. We're going to be going over all the other chapters in later videos, but here we're starting with this. And so this will get into CAPM. I believe this is chapter either 8 or 9. I'll put it in the description as well as the title. And so let's jump right in. So first, a stock has a beta of 0.8. The current risk-free rate in the economy is 1.5%, while the market portfolio risk premium is 6%. Find the cost of equity for this stock. So let me bring this over to draw mode, make sure that works. All right, sweet. So first off, what is the cost of equity? That is the capital asset pricing model that we've been going over. So the cost of equity formula is cost of equity equals your risk-free rate plus your beta multiplied by your market risk premium. That is multiply. So we'll start with risk-free rate, which is this right here. So the risk-free rate is essentially what you can get almost guaranteed when you put your money in some form of investment. And so normally what people and investors use for the risk-free rate is government bonds, because government bonds are backed by the government, and so they're seen as very unlikely to fail. And so by looking at the yield on the 10 or the 5-year treasury, we can get the risk-free rate of, if I invest in a government bond, I will receive 1.5% almost guaranteed. And so we'll start off with that, 1.5%. And then plus your beta. Beta is a measurement of a stock's volatility. And so it's measured against an index. Most of the time the S&P 500, and the S&P 500 is a collection of the top 500 stocks measured by market cap weighted, I should say. And so if the S&P 500 has a beta of 1, and so if your stock, we'll use this line I drew earlier, has a beta of 1, when the S&P 500 goes up 1%, your stock goes up 1%. If the S&P 500, since it has a 1 beta, if your stock's beta is 2, if the S&P 500 goes up 1%, your stock goes up 2%. And so it's just a higher beta equals more volatility, whereas a lower beta represents less volatility. And so that's why it's used in the equation to price equity. And so here we have it at 0.8, and now we multiply by the market risk premium, or here market portfolio risk premium. So this measures everything above the risk-free rate that investors expect to receive on their investments. And so because the risk-free rate is almost guaranteed, like I said with government bonds, when people invest in the stock market, they expect a higher return because of higher risk. Investing in companies, growth companies, like now we can call it Palantir or Nvidia, investors expect a higher return because there's more risk associated with those companies, rather than the amount of risk associated with a government bond backed by the U.S. government. And so we enter in 6% for that. And then if you finish out that equation, you should get 6.3%. All right, sweet. So we are moving along now, let's hop into number 2. So analysts expect a stock to return 15% in the coming year. The current risk-free rate in the economy is 2.5%, while the market portfolio risk premium is 6%. What is the beta for this stock if it's fairly priced? So this is essentially what we just did, but instead of solving for that 15% stock return, we're going to be solving for the beta. And so this means that the 15% return is equal to that 2.5 risk-free rate, because remember the equation, risk-free rate plus your beta times your market risk premium. So your risk-free rate plus your beta, and we're looking for beta, so we don't know that, multiplied by your portfolio risk premium, which is 6%. And so that means when you rearrange the equation, subtract 2.5 from both sides, that's 2.5 from both sides, and then divide by 6%, divide by 6% on both sides, you end up with this equation. You end up with 15% minus 2.5% over 6. And that equals 2.17. So that, here, let me separate those two. 2.17. And so that equals a 2.17 beta, which is very high. Like we said, it measures volatility. And so since it's above 2, if the S&P 500, which is a common measurement for the market as a whole, goes up by 1%, your stock will go up by more than 2%, but also vice versa. So that is a very volatile stock. So moving on down, an investor purchased Google stock this morning for $875. Google stock has a beta of 1.2. The current risk-free rate is 2%, while the historical market portfolio risk premium is 6%. If CAPM holds for Google, what should Google sell for in 1 year? So first, the solution for this is we are going to get into the CAPM formula. So let's first look at our risk-free rate, which is 2%. 2% plus our beta, which is 1.2 times market portfolio risk premium, which is 6%. And then if you put that into a calculator, you will get 9.2%. I have all my notes with me, that's why I'm doing it quickly. And so what that means is with that 9.2%, which is also 0.092, you can measure the stock of what it's supposed to be versus what you predicted it to be. And so that's the way that they do it in the textbook, is finding that 0.29 and then multiplying it by that 875 plus 875 to get 955.5. But I find this method easier, and so we can use that one instead, because my teacher mentioned that method first, and so I just want to go ahead and mention it. But this is the one that I prefer. Future value equals your present value times 1 plus R. And that also equals your stock price today. Stock price today times 1 plus your stock return. And so that means that the future value is equal to the stock price today, which is said this morning, it is 875. So 875 times 1 plus R. Now your R is that 9.2% that we solved for earlier for the CAPM formula. The R, like we solved for, is that CAPM rate. And so 1 plus that 0.092, and that also gets you to 955.5, which is the final answer either way, but I prefer this method. Then let's hop down into the next one. So a stock has a standard deviation of 40% and a correlation with the overall market of 0.2. So if the market portfolio has a standard deviation of 20%, what is the beta for this stock? So we'll hop into this essentially the same way that we solved the other ones. You kind of just have to know the formula for it. And the formula for it is that 0.2 beta times your 40% standard deviation over 20% market portfolio standard deviation, which is equal to 0.40. And so here you can notice that the stock has a larger standalone risk than the average investment, but the correlation is very low. So much of the risk is diversified away, which is kind of a good thing. You can see that in that problem. And so now let's come down. I'll zoom in a little bit. Oh, I gotta exit out of there. And so we will hop into this one. I took this picture straight from one of the previous tests. So this is something that has been asked before. So an investor is trying to estimate the required return for a purchase NWO stock. He's gathered some data, but is having trouble figuring out how to apply it to CAPM. Help the investor calculate the required return for his investment. So like I said earlier, that 90-day treasury yield is your risk-free rate. Those are government bonds or government yields that are almost guaranteed. So that will be your risk-free rate, which is 3%. And then you add on your beta, which is NWO beta 1.2. And like I mentioned earlier, the S&P 500 expected return is 9%. And so these are all measured against the S&P 500. Now, your market risk premium isn't 9% because that's the expected return of the market. Your market risk premium is everything you expect above the risk-free rate. So that means your market risk premium is 9 minus the 3%. Because you can get 3% almost guaranteed from government bonds. And so that risk premium is everything investors expect over that bare minimum floor. And so when you put that into your calculator, you get 10.2%. So I will be making this video into two parts because it started to get a little bit long. And so I'll be posting the second part very shortly, but thank you so much for watching, and I hope you tune in. I'll be going over all the other problems in part 2 of this video, and then we'll be going down the rest of the finance concepts a bit later on as we go throughout the semester. So thank you so much for watching, and I look forward to seeing you in part 2.